But there's also a problem of the failure of many of the investors to understand risk. And there's a problem, and I talk about pervasive problems that we call agency, of people acting on behalf of others in ways that don't really adequately represent those that they're supposed to represent. Now, in a way, what is surprising about the crisis is that so many people are surprised, because there have been crises throughout the history of capitalism. There's actually been only one period in the history of capitalism, a short period of about 35 years, in which there were not any major crises around the world. And that was the period 35, 40 years after the Great Depression. What happened was very simple. We learned the lessons in the Great Depression. We set up regulations. In the United States, we call it the Securities and Exchange Commission and other regulations. And we stopped a lot of the bad behavior. And it worked. And it was a period not only of stability, it was a period of rapid economic growth. And it was a period in which the benefits of that growth were reasonably widely shared. But then, in the late 70s, early 80s, in the United States and the UK and some other countries, the fact that things had worked so well led people to say markets are working on their own. They weren't working on their own. They were working because the government was setting out rules that helped it work. And in the subsequent 30 years, as we started stripping away regulations, we didn't put in new regulations to respond to the new problems like derivatives. As we appointed people like Greenspan, regulators who didn't believe in regulation, and we got the result that was predictable, around the world, there was crisis after crisis, 125, mostly in developing countries. And what's different about this crisis, in most ways, this crisis is very similar to the crisis that went on before the Great Depression and the crises that have gone around all over the world in the era of deregulation. What is only different about this crisis is that it's in the advanced industrial countries rather than in the periphery, and it's larger. But as one often says, the United States does things bigger than other countries. So that brings us to the question, why was there this deregulation? Well, there were two parts of this. One is politics, special interest. America's political system is in many ways, you might say, corrupt. We call it corruption American style. We don't actually give money to the government officials, as occurs in some other countries. We give campaign contributions, and then when they leave the job, they get a good job in Wall Street or somewhere else. So it's a peculiar form of corruption that's all legal, but is corrupt nonetheless. Campaign contributions, lobbyists. There are 5 lobbyists from the financial sector for every congressman. He can't escape from the lobbyist. And finally, we have the revolving door. People that come from the financial sector, spend a little time in government, and then move back to the financial sector. Sometimes there's a little diversity. They come from Goldman Sachs and they go to Citibank. But they don't necessarily go back to the same firm, but it's from finance to finance. And it's not just incentives, but economists say incentives have to matter, but it's also mindset, how they view the world. But as I said in the beginning, there are many people to blame, and among the people are economists. I say other economists, who put forward the idea that markets are self-regulating, that they are self-correcting and efficient. One of the most important influential ideas in economics is Adam Smith's invisible hand, that firms in the pursuit of self-interest would be led as if by an invisible hand to the well-being of all of society. Well, my own work on the economics of information showed that the reason that the invisible hand often seemed invisible was that it wasn't there. That the market was, in fact, in general, not efficient. I don't think anybody today would say that the pursuit of greed by the bankers led to the well-being of our entire society. Quite the contrary. So the irony is that at the very time that deregulation movement was gaining strength, good economic theory was explaining why markets often didn't work. But of course, we should have known that from the Great Depression. And in fact, government policy actually led to what some people have called the super bubble. That Greenspan, the Fed, kept bailing out the economy. Whenever there was a problem, he would lead to a flood of liquidity that would create a new bubble, allow the economy to go, and if you can see what happened, if you look at a chart, you see the bubble is getting bigger and bigger until the current bubble. The worry is that this newest bubble, that what we're doing right now is creating another bubble. The Fed is leading to a flood of liquidity, but it's not going to credit, as you saw the chart. It's creating bubbles, mostly in emerging markets. And many of them are becoming very worried. Well, there are about a few questions that I keep getting asked, and let me go through them fairly quickly before I come to the last part of my talk. The first is, can China's growth be the basis of global recovery? I mentioned before how strong the recovery in China and Asia is. This growth is very welcome, but unfortunately, while China and India have been growing very rapidly, they still remain too small a share of global economy to be the basis of a strong global recovery. They can help particular countries. Their demand for commodities, for iron ore, are helping countries like Brazil. And if you happen to be selling the particular commodities that China's demanding, it's great for you, but it won't help the United States and Europe. The second question is, China's growth be sustained without an American recovery? It's possible. These countries have vast untapped domestic demands, but it's going to be very difficult over the long run. China has not yet succeeded in reforming its basic export-oriented growth model, and it's going to be very difficult for it to sustain the kind of growth in exports that it's had for the last 30 years. It knows that it has to change its growth model. 4 years ago, it had an 11th five-year plan, said it was going to decrease savings and restructure the economy. And what happened is savings increased to the point where today the savings rate in China is over 50%. So that gives you a glimpse of the magnitude of the challenge which they face. A third question is, how worried do we have to be about inflation? In the short run, deflation is the more immediate issue. In some countries, some products, China's huge demand for resources may lead to some cost-push inflation. What worries me, though, is that inflationary expectations, because inflationary expectations are likely to drive up long-term interest rates. That's already happening. If that happens, it will serve to dampen the economy. And the Fed's ability to manage this whole process, the ballooning of its balance sheet in a way that's been, I'd say, historically unprecedented, is questionable.